Let's look at what we have here. We are looking at last week, IVV and VU, the big retail S&P 500 ETFs, hauled in record amounts for each. Now we've got the trading crowd in with SPY, the Qs, J and K. They had seen outflows the week before. So the traders are back in. Institutions, liquidity, people who are looking for liquidity are back in this market. So the common thread here is U.S. large cap. There's a couple other interesting ones on the leaderboard, which is junk bonds, definitely seeing a bid. HYG and USHY, which is a broader version of HYG. And then also you've got LDM, which came in at 600 million. It's an ESG ETF. More and more we're seeing ESG on the leaderboard thanks to institutional seeding. Let's look at equities versus fixed income, because remember last year, it was the year of fixed income for many, many months. Exact opposite this year. Equities are firmly leading fixed income in flows. Equities have taken in $42 billion in about 6 weeks. It took them 6 months to take in $42 billion last year. So that's how bullish the flows are, at least for equities right now. And they're really concentrated in large caps. Let's look at different cap sizes, and you can see here, this is large cap. They generally get more because they're a bigger area. But look, small and mid, nowhere to be found. Normally there's at least a little trickle there, but this is all large cap. So Scarlet, nobody's even playing games anymore. They're just going after U.S. large cap equities, and they've got a bullseye on their back.
All right. This week's roundtable features Jay Pelosky, CIO and co-founder of TPW Investment Management, and Vildana Hajric, a cross-asset reporter for Bloomberg News. Jay, you saw what Eric showed us in terms of the fund flows.
I did.
We're 6 weeks into 2020, and the 2019 playbook still applies here. Go big, go long on U.S. mega caps. Do the fundamentals justify the record highs that we've seen and continued outperformance of U.S. stocks relative to the rest of the world?
Well, I think the record highs make sense mainly because of three factors. We've had better than expected global growth data. We've had abundant liquidity, not only from the Fed, but also from the PBOC in China and elsewhere. And most importantly, I think we've had better than expected earnings, not only in the U.S., but also in Europe. The issue of investors, just as Eric said, going back to the old favorites. I mean, we had a period in November and December where ex-U.S. outperformed, value outperformed growth, and cyclicals outperformed defensives. In January, all that stuff reversed. I think the people who questioned the rally hopped on the old winners. And most importantly, I think the long bond rallied significantly. And I think there's a direct, unusual connection between the long bond rallying down to 1.5% and large cap growth technology outperforming, because people value those cash flows in a different basis off the 10-year. So a lower yielding 10-year means you can expand that multiple on the other side. Right. So our view is that the fixed income market's going to reverse. Growth is coming back. The virus is just a temporary issue, and long rates will back up. Technology will not do as well, and the opportunity will reset into the ex-U.S. value and cyclical trades.
Okay, well, speaking about the rest of the world, Vildana, the U.S. market obviously incredibly resilient, no matter what kind of headlines seem to crop up. How resilient are investors' faith in EM and international stocks? What are you seeing in terms of flows there?
Well, coming into 2020, there definitely was a sense among strategists that international stocks would for once again start outperforming U.S. stocks. And I think a lot of strategists are digging in their heels and saying that might still happen. They're just pushing out their outlooks into the latter half of the year because of the virus outbreak. And so if we take a look at a fund like EEM, for example, it's seeing some outflows, but nothing drastic. And also, just looking at China ETFs, they've been really interesting. They've been a sort of proxy for when Chinese markets were closed for a couple of days. And they also aren't seeing drastic outflows, but they are seeing huge volume spikes.
Yeah, and we just saw a chart of 3 different China ETFs. I think this really highlights the differences in China ETFs. You've got ASHR, mainland shares. You've got MCHI, which is going to be broad, and then you've got KWEB, which is internet. Jay, talk about your play in China and how you pick it when you've got this much return dispersion.
Well, yeah, it's an interesting, significant difference in the last week or two with the virus, because as people have been quarantined in China, life has moved online as opposed to offline. So the online has actually done better. KWEB has done better over the last 2 weeks than MCHI or the A shares, and I expect that to actually continue, because as we come out of this quarantine period, our view is that we're going to have a kind of a doubling of the inventory rebuild we were just starting to get around the world. Now China, we've exhausted the inventory because of the trade fears in Q4 and the second half of last year. Now we've even doubly exhausted it because of the virus. So we think we're going to get actually kind of a sharp V.
Okay, so it's going to be replacement, not just lost inventory there. Vildana, a risk for 2020, of course, is the upcoming election. The Democrats' Iowa caucuses was a mess. The New Hampshire primary showed that Bernie Sanders won. How's the election factoring into people's investing?
There certainly is a lot of buzz around it. I think a lot of times your views on how politics might impact the stock market, for instance, will align with your actual political views. So there's a big group of investors who are saying a President Bernie Sanders might be negative for the stock market. And then there's also a growing group of investors who are saying, wait a minute, if there is a President Bernie Sanders, he might expand the budget deficit, which would act as a sort of stimulus in a sense. So I think it just depends on your actual political views. And I do want to caution that it's still really early on. We have months and months to go. And Wall Street in general doesn't have the very best track record in terms of predicting some of these political outcomes and how they might impact markets.
Yeah, I mean, I think Trump, everybody wasn't going to GLD. That didn't work out, right? So now we've learned our lesson. Jay, do you do anything, though? Because a new president would definitely change. It would be a catalyst in one way or another. Do you shift at all if Bernie keeps rising?
Well, I think it will be a catalyst in one way or another, right? The question is, can we pick which way? And the history shows that not really, right? And also, typically over the different administrations, there's very little difference in the S&P between Republican administrations and Democratic administrations. So our view is, no, we're not really making any trades based on who does well in whatever primary. I do think, though, if it is a candidate who ends up winning who's not seen as market friendly, that could facilitate more flows outside of the U.S. We're at very stretched situations technically on all of these factors. They're all the same trade in our view.
Yes.
Ex-U.S. is the same as value over growth, same as cyclical over defensive. The non-U.S. developed markets are cyclical value plays. And if we get the move up in growth that we expect and rates back up, that is what facilitates the move to value. That's what facilitates the move to cyclicals. And I think that's what facilitates the move to the non-U.S. equity markets.